Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to have our favorite day, the Primary Vision Frac Spread Count, and we're also going to provide an update on IDA, what's still down on the refining side, on the production side, and then we're going to look abroad a little bit, talking about where some of the flows are coming from, what's happening in China, and then round it out with our favorite topic, inflation, and where we see inflation going and why inflation just will not stop. And it's going to be a very interesting conversation when we start looking at the Fed and really what comes next, because when you look at PPI and what does that mean for CPI, well, we're just going to talk about the supply chain, and then obviously we're going to do a much deeper dive next week. So I know everyone's excited to hear what the number is. So the Primary Vision Frac Spread Count is 244. So we went up by 4 on a week-over-week basis. We had another little increase in the Permian, but I know this won't surprise many, but we also did get an increase in the Haynesville. So when you look at what is happening in the market right now, because remember, for those that have been following us, we've been talking about how oil has really been a huge focus, where you could say it's anywhere from about 80 to 82% of the spreads have really been in the oil basin side, or looking and focusing on the oil front. So now when you look at the difference between, say, now and 2019, there's still a lot of momentum that can happen. It's just going to be on the natural gas side. Now, when you have front month, it's pulled back a bit to about $4.93 in hub. But when you consider about what's coming and how we sit on the natural gas side, so as we've talked about, we have been lower on storage in 2014 and 2018, but things are different now. And what is different now? Well, one, we have LNG at 6 MTPA per month, and when you look at the shortages in Europe, you look at Russia struggling to refill the coffers, the demand that's been fairly steady into Asia. The U.S. is still seeing a steady stream of flow going offshore, and that really is not going to stop. I mean, you have your seasonal slowdown, which is, again, normal, but maybe we don't even see the same seasonal slowdown, because during that time period, they're going to take that opportunity to try to continue to buy as much as possible to refill storage. So again, there's a lot of support for natural gas. And then when you think about 14 and 18, we've also shuttered oil facilities, not oil facilities, we've shuttered coal facilities. So now what is that gas to coal switching? Can we switch from gas to coal? And the answer is no. Like, we have coal facilities that are operational now, and then we don't have the excess stockpiles. So can we go and mine additional stockpiles? Well, mines have been shutting down. Mines have been, going long wall and just trying to be as efficient as possible and just meeting current demand levels. So again, we're in this level where we're going to see a lot of support for the curve. And then that brings us to NGLs and natural gas liquids in general. Because when you look at propane, we're well below 2018. And I'm going to have to dust off some of the research that I did when I was at Bloomberg. When we talked about the potential for throwing up a gate, and what does that mean? So when President Obama, former President Obama, talked about, created the ability for us to export oil, it also allowed us to export more propane. We started to build more facilities, and that created this movement. But there is within context, we do have the ability to throw up a gate and stop exports. And this is very specific on the propane side. And it's more important to look at days of supply or days of cover of when we start to see some of these concerns. Because if we have a really bad cold snap, and that's just, if we have a snowmageddon or a snow bomb or whatever the freeze off or whatever fun terms that the news wants to label it, within 3 days of sub-zero temperature can pull 10 days worth of demand of supply out of storage when you're looking at propane. So as we start to get to below 20 days of cover, there's going to start to be some concern on, well, how much, can we maintain normal operations in the U.S.? And there is the ability where we can say, look, it's an all stop on exports. especially on the propane side, we have to take care of ourselves. Now, this is not a situation that would be taken lightly, because you're gonna screw up the companies, who we're selling to. It then becomes market risk of, well, do we really want to trust the U.S. if they're going to keep doing this? So there are a lot of things that we have to consider when we look at where is activity right now, and where is the market going to be, and is there going to be an incentive to continue to increase our production, or I should say completions, when you're looking at the NGL and natural gas basket. Oil's still going to see some growth. We still have a little bit of growth to come in the Permian. Same with the Williston. Same with some of the other areas across the Anadarko, which is again that liquids base. But that's why when we say that we've had an increase of 4 from 240 to 244, we still think that really by that first week of October, we're going to see 254 spreads active. So we do see another 10 coming online over the next 4 weeks. There are some individuals, companies that have paused for September, but we're going to see that activity pick back up in October. And then we will see additional 1 or 2 spreads getting active in the smaller basins, which is also going to provide a little bit of that bump. And then when you look at what happened with the rigs today, we did have an increase, but just remember a lot of that is the offshore Louisiana coming back online. We did get some increase in activity. It was mostly in the Permian, but again, September, we still see a very steady flow of new rigs coming on in September into October to again stop the DUC running through these DUCs and really starting to rebuild some of that inventory. So now when we turn to Ida and what has happened so far, we just want to look at what has been reported. And this is just looking at the atmospheric distillation units, or the ADUs, and this is just kind of a gauge of what has happened. So you can see that there's been a small increase of downtime, but remember this is looking at Pad 3 in total. So when we look at just Louisiana, there's about 1.8 million still offline, and there was some hiccups, which is why in Texas, which is why Pad 3 covering the Gulf of Mexico, that you have that little increase. We will continue to see some facilities come back online. We do have Marathon is now fully operational, as they've said. The Loop, as of September 9th, said that there is no disruption and that they are fully operational. But on the other side, where are the issues? Well, Shell's Norco refiner, which is a 230,000 barrel a day facility, said that it's going to take several more weeks to repair. And then on the flip side, Phillips 66 Alliance refiner. Now, remember, that was slated for sale. So they were already trying to sell Alliance. And now they're saying that the damage is so severe, it may not be cost appropriate to fix it. So they may just shutter it altogether. Now, again, this is still early. They're still assessing the damage, but just gives you an idea that these are 2 facilities that will be down for a longer period of time. And there is still about 1.8 we still think is a bit high. We think it's closer to about 1.7 million barrels a day of refining throughput that is down. But now when we go offshore and we look at production, we have to look at, okay, well, what is the estimate right now from the BSEE is that there is still 1.2 million barrels of a day of production shut in. So remember, we were at about 2.1. We're now down to about 1.2. But the biggest issue, as we talked about in the EIA show, was that Port Fortune, which had a significant impact and is where a lot of the launching points for the Gulf of Mexico is really launched from. So the E&Ps, the producers, the operators, they had to address that. So they've picked up slips and space in other Louisiana ports, in other slips within the port, and then helipads and some slips out of Texas. So now that they have some of this temporary facilities, temporary supply chain set up, that we're going to see that increase the production come back much faster now that things have started to get streamlined. And when we look at just some of the other components that have happened, and we talked about this in our insights that went out to clients today, Nigeria is just speaking of them at the moment, because Angola has seen a little bit of a pickup in sales, which is a positive. Congo still has 2 to sell. But Nigeria has been struggling. Now, when we look at October, and just to be clear, Nigeria, October is the lowest production of oil and condensate ever for Nigeria. And yet they still have 2/3 of crude still yet to find buyers for October. So about 30 vessels that are still struggling to find a home, which again, 2/3 is a huge number to still have available, going into the second week of the second week of September for October. So this is where we continue to see some of that struggle. And then some of the reasons why. So when we look at China Shandong crude stocks, you can see that they're near or right at the all-time high as we look back throughout history. And when you look at, as we said during the EIA show, there's still a huge amount of offshore capacity. And then when you look at the typhoon, it's going to hit two key ports when you look at China. So again, there's going to be an issue on the supply chain. There's going to be an issue in terms of demand. So in total, 89 super tankers are bound for China in the coming few months. That's up from 83. Within to the U.S., we're at about 17. So we went from about 22 to 17. And this is going to ebb and flow with early estimates that the U.S. has just purchased another 5 million euros. So again, we're going to have the Gulf of Mexico coming online quick, coming on faster. Then you have the loop that is now operational, and you're going to have these boats showing up, which is going to help offset some of these drop downs while refiners continue to struggle to come up. So when you look at it, you have to take both sides. You have the demand side, and then you have the crude supply side. And then when we look at Alliance, that's taking about anywhere from 253,000 to 280,000 barrels a day of throughput offline, depending on which processing we're looking at. Then when we look at fuel oil, I just think this is a funny chart, just because China, and I've asked friends in that are teapot traders out of Singapore, what are you guys going to do with all this fuel oil? Because are you going to recrack it? Are you going to sell it? Are you going to trade it? Like, this just seems like a very big number. And as we said during the EIA show, we've seen a big increase in diesel and gasoline exports from China into the global market, and a big increase for so far in as we exited August, and as we get into September, it's been a big increase. So now when we turn to some of the bigger impacts. So one of the things that I always like to look at, especially when we're talking about demand in the U.S., is wage growth. And this is breaking it into the four quartiles. So the first quartile is the lowest 25%. So those are the people that are making the lowest amount of money in the U.S. And then obviously as you get to the fourth quartile, that is the highest. So when you look at this number, and as we keep talking about it and it keeps proving out, the lowest quartile, or the people that are making the least amount of money, are seeing the biggest percentage increase. But at the same time, those aren't the ones that have the discretionary cash. They're not the ones that are really the big spenders. They're not going on 2 vacations a year, buying, going out to dinner a lot. And not to say that they're not doing some of that, but it's just they're not doing it at the same level as those in the top end or the top quartile are. So when you look at it, you can see that the top third and fourth quartile are moving in the wrong direction. So when you look at the first quartile, it's the highest. Second is starting to move a little bit. But the fourth and third are coming down, which is keeping the overall flattish to down, which again is just, even though we keep hearing about wages and wage expansion, I always think it's very good to put it into context as to who is making the money, where is that money going, and what are their spending habits. And then when you take this adjustment and then factor in where we are with inflation, well, a lot of these increases are getting absorbed into just a rising cost of living, which again was supported by PPI. And what does that mean for CPI? So now when we look at jobless claims, so continuing claims were up a little bit. Jobless claims continue to move in the right direction. The consumer comfort, the Langer consumer comfort ticked down a small amount, but still within a semblance of normalcy. But one of the things that we want to look at is how do these claims change? Because remember, September 6th was the last day that you could claim extended benefits. So we'd like to see some of these continuing claims, start to come down, initial claims start to come off, and that's going to be something to watch. And we'll do a deeper dive next week when we do the econ show. And then just as we do, CPI comes out on Monday. So on the econ show, we're going to have a deeper view of PPI and CPI. But just looking at the producer price index, you can see final demand coming in at 0.7%. Estimate was for 0.6. But remember, the estimates have a range, because they poll different people. So the range was 0.3 to 0.8. So we're at the top end of these estimates. Now, given the survey averages down to 0.6, but we're at the top end of even where the most, where the most bearish people or the most, inflationists think that we were supposed to be. So then when you start peeling back the onion, taking out food and energy, we're right in line. Taking out trade, that's where we see a lot of the breakdown. Now, I get taking out trade, but when you look at the supply chain and the fact that we are an importing nation and our export prices are going up, our import prices are going up, sometimes I think it's a little foolish to take that out, but just to give you an idea of where is core. So I understand it, and we'll talk through it in general. But then when you look at the PPI final demand year over year at 8.2%, 8.3% versus an estimate of 8.2%. And we're continuing to see this happen. But now when you look at it year over year, ex-food, energy, and trade is right in line with estimates at 6.3%. So we're still seeing this very steady move up, because remember, the prior was 6.1. When you look at PPI final demand year over year, last month was 7.8. Now it was 8. Now it's 8.3. So we're still getting this steady grind higher. So let's put it back in and look at it on a chart wide. So when you look at what happened in August, now, and remember, this is the front end. So this is the corporate side. So this is yet to get passed down and will continue, or they'll try to push it down as much as possible. Again, keeping some of this pressure on the consumer. So when you look at it, just especially going back to 2011, you can see just how elevated we are and how the trend continues to go up. Now, the pace is starting to slow, and we'll see that pace come off a bit, but still moving in the wrong direction, especially when you look at the typhoon. Where's the typhoon hitting? How many ships are sitting at port? Where is pricing on the commodity side? As we talked about, China releasing 22 million barrels of crude from the SPR, aluminum, tin, coal, copper, all of these things to try to adjust and bring pricing down, because there's only so much they can push into the export market. So then when we look at PPI versus CPI, here's where you can see that little bit of a pause in the PPI, how that reacted in the CPI level. But now we've had 2 straight months of really direct increases. And you can see how that typically reacts and how CPI reacts with it. There's usually that delayed response, because the companies recognize it, they or realize it based on what they're buying, what their raw materials, their supply chain, and then they try to push through as much of that pricing. So there is that lag of when it shows up in PPI and when it shows up in CPI, and it's never a direct one-to-one, as we've explained time and time again in the econ show on prices paid, prices received. So then when we take the US PPI finished goods, so this is the way things, used to or were calculated more, but again, it's still available. So US PPI finished goods year over year is at 10.5%, which is the highest since 1981. So just to put it into context, because when you can break it down, this is looking at finished goods. So the finished good that is sitting in the shelf that you're going to purchase is, again, that cost is up 10.5% year over year. So then when we look at that cost pressure persisting, you can see just how long it's been there when you look month over month. So going back, obviously April was a very unique time, but when you look at January, February, March, April. So when you look at April, May, So when you look at May, essentially May to now, we've had a very steady month over month increase. We had a little bit of a pause in November, but again, you're seeing this steady move up. So when you look at the producer price index for final demand at 0.7%, the Labor Department showed Friday both higher than the medium forecast, and excluding the volatility, food and energy components, the core PPI was at 0.6%. So you can still see, again, that pace. We're not going to see this huge step up, but this is what the Fed doesn't want to see. And the reason why I say that is because the Fed, for something to be really transitory, we need to see this big explosion higher, this big blow off top. All of this is getting realized, and then it starts to come back down. Instead, we're just stuck here. And when you look downstream like we do every week, that's not changing. And it's only actually getting a bit worse when you look at the pricing that's happening abroad. So, and why is that the case? Well, let's look at inventory. So peak, retail sales divided by inventories ratio, inventories, it gives you the ratio of, what is that sales to inventory? And it's still above 1. As going back to 1992, we have never been at this level, which is why companies, even though they see the prices, they have no inventory. There's the inventory is light. They're trying to pick it up. But this is where some of this disconnect comes in. So when you turn around and you're looking at where this pricing is, you might say, well, why don't the companies wait a little bit? They don't have they'll have a choice because their inventories are so low. They become price takers. They're not price setters of like, look, you're too expensive, I'm going to go over here, or Vietnam is this. A company based in South Korea is something different. Everybody is seeing this marked shift up, which again is keeping that pressure, which continues to move down. But it's not this blow-off number. It's just this very sticky, very annoying number, if you will, that is going to make this inflation conversation after seeing, now over 14 months of increases, very hard to say that at what point does the term transitory no longer fit with the narrative? Because 14 months, you could say that, on a broader scale, when you're looking at economic cycles, 14 months isn't long. Okay, maybe we can define it like that. But again, that story or that view is getting a bit long in the tooth. Next week, we're going to cover WASD in a bit more detail and grains, just to look at what did WASD come out with. Some of the numbers were a little bit better for stock, and by better, that usually means, bearish pricing, but pricing has had a little, I would say, fairly steady. And I think some of the estimates were, some of the things were fairly in line, a little bit bearish in terms of a bit over the levels in terms of stock, especially when you look at soy and corn, soybeans and corn. But again, these are things that we're going to go into into a bigger backdrop, because we want to look at how is that going to impact grain pricing and going forward, especially when you look at CPI. So hopefully everyone has a great weekend. As we know, it is September 11th, and we can all reflect on where we were when it happened. I was a senior in English class in high school, senior in high school in English class at Chaminade in Mineola when it all went down. And yeah, that'll stick with, I think, everybody to this point in time, and based on just the smells, the sounds, everything that was happening at that point in time. So again, we remember those who were lost in that tragic event. So, but on a happier note, we do have a lot to be thankful for. We've come together. At least we did come together. Hopefully, we'll come together again as a nation and bridge some of these gaps, and come out better on the other side. So thanks again for watching. We hope you have an excellent weekend with friends and family. So again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.